Yeah, it's quite stunning to see actually. If you look at the massive productivity slowdown in Europe, but also the US over the last 10, 20 years, since about the mid 2000s, there's essentially two primary drivers that stood behind that. The one is that digital, in many ways, over that time period has maybe disappointed. It has not allowed the same levels of productivity uplift that you saw on the first wave of ERP system software, computerization, and so on in the late 90s. Much because of transition effects, like you have online and offline retail combined rather than one versus the other. Much because of also, if you will, infancy. Like 10 years ago, the smartphone was still in the hands of very few. It's only over the last really 10 years that it picked up to be everywhere, as one example. So it's essentially a bit of an S-curve effect on the digitization front, on which now both time in general, but also the shift by the pandemic has taken things to a whole new level. So we will now see the impact of digitization also in the productivity numbers. But then there's a second factor that has held back productivity growth, and that is essentially investment and capital deepening. So capital deepening has been at its lowest levels since World War II over the last 10 years. The lowest levels since World War II. It's almost unprecedented in peace times. And it's not for lack of money. That's what we see in the explosion of the balance sheet. The financing and capital has exploded. It's somehow people haven't found the investment opportunities to be worthy to actually really do new capital formation. And this is kind of what's also then getting a little bit at some of the questions on European policy that you mentioned, that there's a lot of talk still about how can we deploy the development banks, provide new financing instruments and so on for capital to flow. But it's not the financing that is missing. It's the framework conditions for people to see a profitable business case and put their money down. So on some of the big investment opportunities, so for affordable housing and housing more generally discussed, the net zero transition is there's many tools that you can deploy to turn those into a positive investment case, from raising regulatory standards and enforcing investment over actually somewhat the opposite, taking some of the regulatory barriers around. Just imagine all the discussion about the inability to deploy wind turbines because of local regulations and public opposition and so on. To, of course, changing the economics via carbon pricing or other externality pricing. So there's a lot of things that you could put in place to make the economics better. And then on the more, say, traditional business investment and digital investments that are also maybe most relevant for workers to see their income grow. In all discussions we have in our clients, but also our research, our service and so on, it's mostly about prospects of demands. Firms invest and firms raise their productivity if they see demand that is exceeding their current abilities to supply. That's kind of, in a nutshell, the very simple logic, maybe oversimplified, but it is kind of that simple. And that has been lacking in the last decade. Prospects were not seen as good and bright. Seems to be picking up now. That's also all the talk about concern of inflation are essentially also a concern that the current supply chain cannot deliver. So that is actually a good, if you will, a good trigger for more investment. And we now need to observe the kind of, as policymakers, to observe the situation closely and adjust policy that the pressure on the demand side is kind of kept, not in excessive levels, but things will evolve probably in all kinds of directions as the pandemic also evolves. Yeah, so our research shows a very strong link between decreasing interest rates over the last 10, 20 years and growth in the balance sheet. Growth in the balance sheet, both on the financial side, where low interest rates, together, of course, with the liquidity injection by central banks, have increased the demand for finance and debt, and have also increased, of course, the discounted net present value of firm earnings, and this way share prices and financial assets and liabilities. But low interest rates are also strongly linked to the price increases in real estate, where many of those price increases, 3.5x at the global level over 20 years, so really more than 3 times, are linked to a difference in multiple between rents and price that is driven by lower interest rates rather than increases in rents. So there's really this very strong link of interest rates and the balance sheet explosion. And that also means in turn that should interest rates go up, we would expect a normalization and reversion of the balance sheet size with GDP, either by kind of slower asset price increase or even negative developments on the asset price side. Now, that is a big if. It's still a big if whether and when and for how long interest rates will really increase. I think the jury is out on that.